Well, a number of reports over the past 24 hours pointing to a recession coming in early 2024. Will it be Q1? Will it be the second quarter of 2024? CEO of Double Line, Jeffrey Gundlach, just came out and said that he believes a recession is coming by 2024, and he thinks the interest on the debt is a huge reason why. Watch.
The interest expense on the debt is exploding in a vertical fashion because all of those bonds that were issued back at 25 to 50 basis point interest rates, or maybe only as high as 1%, they're all rolling off. And they're rolling off with great speed. Already, the interest expense, since the Fed started raising interest rates, has gone up by hundreds of billions of dollars, almost $500 billion per year. Yeah. And it's going literally vertical. My belief is that we're going to be in recession. If we're not already in recession, we'll probably be in a recession by the second quarter of 2024.
Another report coming out showing that consumer confidence is plummeting, spending is drying up, and freight recession is also on the horizon. So what is actually happening right now, and how can you protect your family? Every few months, we love to check in with Kevin DeMerrit. He's the CEO of Lear Capital, a good friend of the show, to see what's going on with this economy and kind of make sense of it all. Kevin, great to see you. Welcome back to the show.
Yeah, thanks for having me back, Clayton.
My pleasure. My pleasure. So we hear this report from Jeffrey Gundlach, and we see a number of indicators over the past few days pointing to an early 2024 recession. I guess we always get that sort of Christmas bump, where there's a little bit of temporary hiring. People are sort of, in that Christmas holiday spirit. And then January and February hits, and we could be in for a crap show. What are you seeing right now, and how can you make sense of this?
Well, we look at a couple of things. You brought up the freight. So when you look at freight, one of the indicators you look at with freight, if you can believe this, is cardboard boxes. If you see a dramatic slowdown in cardboard boxes from manufacturers to people who need to deliver it. So I don't know about anyone who's listening to the podcast, but I seem to have an Amazon box show up almost every single day at my house. If you see cardboard boxes starting to decline, usually it's a decent indicator of where the economy is going. Sounds very simple and basic, but a lot of people use it, and it's extremely accurate. So I think the freight slowdown is one thing. Gundlach is talking about the interest on the debts, going through the roof, not just for the U.S. government, but for consumers as well. So if you look at bankruptcies filed, we are at the same levels of bankruptcies that we were just prior to 2008 from the Great Recession. We are at the same level as in COVID. When you look at personal debt, near record levels, credit card debt, near record levels, actually exceeding record levels, late payments on vehicles, climbing to a record level again. These are usually the indicators that say the consumer is tapped out, the free COVID money's at the end, and they're going to slow down their purchases. So what you've seen with a lot of the earnings coming out is that, yes, we may have had a great third quarter. Fourth quarter, we're a little bit concerned because consumer spending is slowing down. They're having to spend more on food. They're having to spend more on interest payments for their mortgages, credit card debt, vehicles, so on and so forth. So I 100% believe that in 2024, we are going to have a recession. I don't know, you must be living under a rock if you don't think we're going to have a recession in 2024. How bad it's going to be is the question.
Yeah, and I guess at the end of the day, right, I mean, even if there's not a recession, what harm does it do to protect your family and to make some moves to at least shore up some of this capital to protect yourself in the case we do have layoffs and people are out of jobs or skyrocketing prices? And I think that's a very big concern, especially if freight is, declining. And you're seeing, I'm glad you brought up the cardboard box thing, because I was reading a report on cardboard boxes last week, and I thought, oh my gosh, this is really troubling. Cardboard box demand plunging at rates that we haven't seen since the Great Recession. So That is a true measure of our economy right now. If people are buying things, if people are not shipping things, then jobs will be the inevitable fallout from this. Companies are going to cut the fat, and they're going to lay people off.
Yeah, people think that I believe that, Wall Street has this crystal ball, or those guys have these supercomputers, and, you look at cardboard boxes and you say, hey, look, how does that work? Well, it works pretty good, actually. So yes, those are the things that you're talking about that usually come after. If you're not selling cars, there's going to be some people laid off, that are selling cars. We're already seeing people being laid off because of AI. People are just becoming much more efficient. Do I need as much from my secretary when I have AI, or do I need the answering service after hours when I can have AI answer it? So you've got a lot of different things converging at the same time. People have less money to spend. Things are becoming a little bit more expensive. The earnings are starting to be pulled back by these companies that are looking at it and saying, "Hey, the consumer just can't keep spending at this pace. You can't keep spending if your credit card's maxed out. You can only go so far." So I believe that Gunlatch is probably right, where right around the second quarter of 2024, you're going to start to see the recession, but you're going to see the effects like you're talking about right after Christmas, when you usually see that January effect of, okay, things are on sale right after Christmas. Let me hold off a little bit. A lot of people have been doing that and then purchasing in January. I don't think you're going to see that this year, and that will start to send some alarm bells ringing, and people will start to lay off people, readjust their earnings again for the first quarter and second quarter of 2024.
I've just been seeing, here in the chat, in the chat room here on our show, people are saying like, it's going to be a lean Christmas. Like they're not doing big Christmases this year. People are not going crazy and they're really pulling back. And I know that's just anecdotally here, people watching the show who have been saying that. But still, I think that's an indicator of where things are going. And then when you see the amount of things that you can buy for your dollar, when the value of your US dollar has now declined to such a degree where you go buy a value meal at McDonald's and it's now like $10, $10 to pick up the same thing that back in the 1980s, it was $4, $3 or whatever. So your dollar is going far less. It doesn't have as much traction as it once did under inflation.
Yeah, JP Morgan, right at the end of October, came out and Jamie Dimon said, look, the wars in Ukraine, the wars in the Middle East have far-reaching impacts on energy, food markets, global trade, so on and so forth. True, we are spending so much money on this war when the money needs to be spent here in the United States on a lot of different things, in my opinion, but you're going to see higher food prices for longer. You're going to see interest rates higher for longer. If you're investing today, like you were as the interest rates were going from the high in the 80s down to, really on a real basis negative, but let's call it 0.5%, 1%, and you expect that your mortgage is going back to 3%, you can forget that. You have to start investing today and thinking today that I'm going to spend more money on food, I'm going to spend more money on energy, and I need to change the way that I'm investing from a low interest rate environment to at least an environment of 5% to 7% mortgages, somewhere in that range, because that actually is the long-term average. So we just regressed back to where we normally are, but everybody's in shock because of it. So you're getting the commercial real estate, and the WeWorks just went bankrupt, so it's probably going to cause a little bit more problems with the commercial real estate. People have to change the way they're thinking about their investing at this particular point with interest rates, because it's the biggest driver of returns in almost every segment of investing.
I want to talk about gold. Of course, this is your wheelhouse there at Lear Capital, and many of our viewers, I see them on a nightly basis talking about how they invest in gold, and a lot of them invest in silver as well. And so, but you're also seeing central banks. So central banks are also investing in gold, and they're buying up a lot of gold. We're seeing Russia, China, heck, the United States. A lot of countries right now are swallowing up gold because of what's coming. So there's a lot of like a grabbing of commodities. There's a grabbing of silver. There's a grabbing of gold. There's a grabbing of oil. There's a grabbing of actual tangible things right now. Can you explain why we're seeing these central banks swallowing up a lot of gold right now?
Yeah, so there's two main reasons for these purchases. Number one, if you print up $20 trillion like we have since 2008, the value of your dollar is going to become worth less and less and less over time, right? For every dollar out there, when you print another one, it's going to become worth less. The central banks understand this. They're experts at understanding it because they're the guys printing the money. So the last time they started purchasing this much gold was at the very end of the 60s and early into the 70s, right before inflation took off. That was the last time we saw the record amount of demand that we see from central banks today. Of course, you print up a bunch of money. Why don't we take this money and turn it into gold? Because that's going to go up. We'd rather have that on our balance sheet than a bunch of dollars or treasuries that are going down in value as interest rates go up. So that's the big reason. The second reason is gold does very well when interest rates are high. If it didn't, then gold wouldn't have been $800 an ounce at the early 80s, at 1980, when inflation was high and interest rates were 15%. Well, gold started in 1974 at $50 an ounce and ran its way up to $850 an ounce. Two reasons. One, inflation. Two, big central bank buying through that whole period. So what are they doing again? Started last year with record amounts of buying, the largest we've seen in 50 years. So that would take us back to the late 60s, early 70s. And this year, they've exceeded that again. So you're right. China has been purchasing like crazy. I just got a report yesterday. The demand from China is 14%, has said 14% ahead of the same period last year. Biggest buyer in the world right now. They added 23 metric tons last month alone. That's a lot of gold. That's 740,000 ounces of gold. Clayton, when a central bank purchases gold, they're not day traders. They don't buy today and sell tomorrow. They buy today and they hold for 10, 15, 20 years at a time. If central banks are pulling that much gold out of the market, then you're going to have gold prices near the highs because you don't have enough gold to go around to the rest of the people. It's going to fluctuate. In my opinion, it'll fluctuate in the 1900s up to the 2000s, and it will have its breakout when there's just no physical gold to supply. So if we see this record demand end up in the last quarter of this year, first quarter of next year, you get a recession, that continues, then you get the individual investors coming in because they're trying to protect themselves. What happens to price when you have an increased demand on a fixed supply? It goes up. So that's why people are talking about $2,700 gold, $3,200 gold, possibly into 2024. So I believe gold's a great opportunity right now, great hedge against higher interest rates, great hedge against inflation, and great hedge against the recession. We've already seen all of that happen with gold previously.
So $3,200 an ounce for gold. It's nearing $2,000 an ounce for gold. I know Bank of America has a $3,000 price target for gold. That's a huge jump, but $3,200 for an ounce of gold, and that's amazing.
The gold has a 92% predictability to where our U.S. debt is. So if you took the U.S. debt throughout time, gold would be correlated to that debt amount by a probability of 92%. I would love to go to Las Vegas with 92% odds that I'm going to win, right? Because unless you believe the government's going to stop printing money, which is $1 trillion deficits as far as the eye can see. Matter of fact, it's $1.5 trillion to $1.7 trillion now that they're continually adding. Then you have a 92% probability that the precious metals are going to follow where that debt level is. Well, if you put the calculation on where the debt level exists today, then the gold price should already be $3,200 an ounce. So has this happened before? Sure. It should have been 2000 when it was 1100 back in 2010. Did it get there? Sure it did. It went right up to where it was supposed to be. So for every dollar that they add, does gold just tick up? Is it that predictable? No. So you look over a 3 to 5 year time period, the predictability is there with a fairly accurate track record. So the 3,200 is not just pulled out of the air here. We're looking at the debt around the world and in the United States and trying to calculate a number that's going to be, predictable for investors.
Well, one of the reasons I wanted to have you on is because you just sent me this $3,200 gold report, which I found fascinating. So this number is not just pulled out of thin air; it's calculated on this debt number. I think you put it together. So can you make it available for our audience if they want to read this report as well?
Yeah, we'll make that report available. So $3,200 gold. We go through the whole history of gold, the history of the debt, some inflation and interest rates, so that people can get some sort of an idea what happened to gold in some of the recession. So you got some sort of an idea if you believe that there's a potential recession coming, what gold could do there. So they can just give us a phone call at 800-613-3557, 800-613-3557. Mention Redacted, and that will go out free of charge. So we normally charge for it. We're not going to charge. We'll get the report out free of charge along with our Gold Investors Guide, and everybody can get it for free. They can also go to learredacted.com and just fill out the information. If you don't want to call the number, it's easier for you to do that. learredacted.com, and we'll send it out free of charge.